All right, today we're going to talk about Twilio, Twlo, and a specific strategy you can use to profit from Twilio if it continues to explode in value as it has over the last few years. First, I'll share a little background on Twilio, what they do, why it's growing so quickly, and then how to use a simple set of rules to follow Twilio if it continues to grow. All right, and as always with everything, what I'm sharing with you is trading and it's risky, and you should have a personal financial investment advisor who will help you navigate things like this. All right, so Twilio is a software company that specializes in automated calls and messages. Okay, now you may think, I don't like robots calling me and sending me text messages. That may not actually be true. You may actually really like that. Why is it important? What are they doing? What are they doing to help shape the world? Well, two questions for you to help you kind of see how important what they do is. Have you ever placed an order online and then you got a text message a few seconds later confirming your order, telling you something about it? Have you ever called your dentist and spoken to them on the phone, set an appointment for 6 months, 9 months, a year later, and then you had a phone call the day before and a robot on there telling you the details about your appointment the next day? All right, you see how this is a valuable tool? Well, guess what? A lot of restaurants don't know how to do that. A lot of dentists are really good at dentistry, but they don't know how to do automated phone calls and text messages. All right, and that's where Twilio steps in. They help people do that. So Twilio had 179,000 active customers and accounts as of the end of 2019, up from 64,000 accounts the year before. They've continued to grow in 2020, and the technology is still being adopted. And this is it's called an API platform, and that allows, it's not just they are the service provider to individuals, they are connected to all sorts of technology. So they are the backbone of a lot of the communications you get for things like Blue Apron and eBay and a lot of other online services. All right, I think Uber uses them as well. So while COVID-19 may have contributed to virtual communications growth, people doing more online and people putting more of their services and products online, Twilio's growth is based on larger consumer and technology trends that predate COVID-19 and are going to continue, maybe at a faster pace because of it, but definitely in spite of it. So Twilio is what we call a high beta growth stock, and that means the price is high compared to its earnings and profits. And that's because, like any other high beta stock, the expectation is for a lot more growth. Okay, so if you go look at the fundamentals, you may not see very attractive earnings and profits compared to the price. But there are stocks that have proven decade after decade, 100 years or longer, that when that happens in a strong growth industry, it can continue to grow and continue to grow and continue to grow, and as the fundamentals catch up. All right, so this is a high beta growth stock, so we need to trade it accordingly because there can be big corrections in high beta growth stocks. So we got to be able to navigate them safely. So that's what I'm going to show you next, how to use a simple set of rules to follow Twilio if it continues to grow without hanging on if it corrects or crashes. This is the important side. It's easy to show you how to make money when things go up, but how do you navigate corrections and crashes or when things stop going up and control your risk there? All right, so I'm going to show you both sides of that. Then, how to make sure you don't miss out on opportunities to get into Twilio and other high beta growth stocks in the future. So let me tell you this. Let me ask you this question. Have you ever had a cool idea? Have you ever seen a great strategy? Have you ever had a great investment idea? You believed in, you thought it was great, maybe you started to take a little action on it, but then 6 months, a year, 2 years later, you look back and realize that it worked out, but you weren't involved. Okay? The implementation and consistency of staying in some of these ideas or most of these ideas is one of the hardest parts of trading and investing. And that's what I'm going to show you after we talk about the strategy for Twilio specifically. Make sure you stick around because I want to show you how to make sure you're in it when it's working and you don't just let this pass you by as another great idea that you never followed through on. And we're all busy. It's reasonable, okay? So I'm going to show you how to not have that problem in the future. So this strategy would have made 263% in 4.5 years. It's unoptimized. What does that mean? It's just one indicator using the standard settings. That's it. I don't optimize things. I don't go in there and change things a lot and try to find how to force something to have worked in the past, because I have found that tends not to work in the future. If it can be simple and it can work without changing a lot, and it can work in a lot of different areas, then we have something worth using. And it uses the stock. We're not using options on this. You could use options to implement it, but we're just going to talk about the stock today, and that means no leverage, and we also have no compounding assumed. So we're talking about 263%. That's not compounded even. That's taking profits out of every single trade and putting it on the side or elsewhere. So if you were to compound returns like that, then it could be astronomical what the dollar returns would be. But we're just going to talk about simple straight line returns. So here it is. I'm going to use a basic $10,000 per position size because we can do the math easily. So that's where you see the 260+% in about 4.5 years. You see that it works very, very well at times when it's growing, but there's times when it doesn't work. But what's happening in the stock sometimes is some deep corrections. And if you can make your returns go flat and smooth and just have no returns and basically break even when the stock is dropping, and then you can be a participant in the growth when that occurs, that's how you're a real winner in trading. All right, so here are the step-by-step instructions to use the strategy that created those returns. Number one is add the RSI indicator to your chart. That's basic. So here's a chart without RSI, and then it should look like this afterwards. You should put the RSI indicator on there. Every platform, even free websites, I think like Google Finance or Yahoo Finance, you can add the RSI signal. It's a very easy one. It's not anything you have to pay for that you can add. Second thing is, I want you to get rid of the overbought and oversold levels. All right, and the way to do it, you can either delete them, but what I prefer to do is set them to 50, because we're going to use that instead. We're just going to use a cross above the middle point. So instead of the high and low, I want you to drop it and just put them both at the middle. Okay, so here's what it looks like before. You're given the two green lines, one at the top, one at the bottom, or one around 70, one around 30. And then you go into the settings. You should be able to do this anywhere you go. It'll look different on your platform. This is TradeStation, and you can do it in YouTube, Google, or Yahoo, or Thinkorswim, or Schwab, or anywhere else you are. You can change those settings. Get rid of the 70-30, make them 50. And also make it a 60-minute bar interval. Okay, so up here at the left, you can see where each bar is 60 minutes. The RSI indicator is the default settings, except we're getting rid of the 70 and 30 lines and just making it 50. And the fourth step is actually a psychology step. This is you preparing to participate in this without getting stuck. All right, so the fourth step is not a technology step, it's a psychology step. It's to remove your old thinking that trading must be complicated to be profitable. Now, I'm not picking on you. I'm reflecting on my own challenges in the past and my conversations with many traders over the years that they've had the same challenge. So I'm expecting and suspecting that you may have a similar challenge to overcome. Remove your old thinking that trading must be complicated, that we have to change the settings or add 16 other rules or add confirmation or add another filter or anything like that. That something this simple can work, okay? But I'm going to talk to you about why many times it doesn't. And it's not because of the strategy, it's because of the execution. Number 5, when the RSI indicator, this is how simple it is. Are you ready? When the RSI indicator is above 50, it closes above 50, then buy the next bar. Okay? That's the entry. And then here's the management and exit. When the RSI closes below 50, sell it. That's it. That's all I got for you on the strategy. That's what created 263% returns on RSI. No special sizing, no special filters, no earnings handling, no nothing. No options, no hedging, okay? No long-term trend, no mean reversion, entry points, etc. That simple. That's it. But is it reliable? Can something that easy be reliable? Well, the only way to answer that well is to put it to the test, what we call out of sample, an out of sample test. And out of sample means to implement the algorithm. What's an algorithm? It's if-then decision making. To make a decision, if you have to take this and then say if this, then this, and especially if you have to do that multiple times, if this, then this, and this, etc. Okay, if you have decision-making processes, that's an algorithm. Take the algorithm into a different area. Take it to a different market. take it on a different time frame, take it over a different period of time on the same asset, and if the results are similar, then it's more reliable. If you can't repeat the results in a different area using the same decision making, then it's not reliable. Okay? So here it is on the S&P 500. Over 29 years, this is the return. This is compounded, by the way, but this is the return. 29 years, if you use this algorithm on the S&P 500, would be profitable. Apple, over 9 years, using this simple algorithm, would be profitable. Tesla would be massively profitable. Shopify would be profitable, very profitable, actually more than all of them, all the other ones combined, I think. SVXY, that's the volatility ETF, the inverse implied volatility ETF, the VIX futures market flipped upside down and put into an ETF, also profitable. All right. So, but are these cherry picked? Sure, I can show you that it would work on Twilio, and then I can go find some other things as examples, and now I've just presented to you thousands and thousands of data points that show it would be profitable over time applied to many things. But still, did I just cherry pick things that would work? Well, yeah, a little I did. Okay, to be honest, yes, I went and made sure I showed you some really good results. But there's another thing we can do that's very important to make sure that this is still worth doing, even if you're not comfortable picking stocks that are going to continue to work. So what I like to do is, let's go look at a complete loser of a stock that doesn't work on RSI, that's done nothing but go down, has not grown, was expected to grow but didn't, and see how that does. And if we can control our risk, maybe make some money sometimes or not lose very much there on an absolute dud, then we've really got something to work. Because if an absolute dud is this much risk and a big winner is multiples, maybe 100-fold of that risk, I'd repeat that all day long, wouldn't you? So here's Groupon. Groupon is a really sad story. I don't know if it's split adjusted or not, but whatever, if you go back through the charts, you'll see it's $500 split adjusted original price has gotten as low as in the teens, $20 or so. That's abysmal. And if you were to think that's a great stock that would have worked, that'd be logical. It was a modern stock. It's about shopping online. It's an innovative idea. They have a lot of customers. But the stock price has done abysmal, has terrible performance. And following signals would have lost some money. But here's the good news. What? It's good news? Yeah, you can pick a high beta growth stock, something that was supposed to grow, that was technology stock, all this stuff, and it wouldn't work. But why is this good news? Because it only lost 3.8% per year. Okay, and it does that because a lot of the times you're out of the stock. When the RSI indicator is pointing down, you're just not in it. And you try to get in and it doesn't work. You try to get in and it doesn't work. But every once in a while you do catch a winner. And that adds to the P&L and prevents you from losing too much. So if you're only in when something's rising and you lose a little bit when it falls, and you repeat that not only in the stock but over multiple stocks, it's hard to lose. So, for example, if you were to pick 8 Groupons and just one Apple or one Twilio or something that's had similar performance, you could still be very profitable, because in Groupon you only lose a couple percent a year because you're controlling your risk using good signals and you're not adding something that's losing. And then if you isolate the returns of Apple and Twilio and something like that, and you follow that and you follow that, and as it makes more, you take some of the profits and you keep it and you add it back in, maybe move your profits elsewhere too, but you compound those returns inside of that asset, you can make massive multiples of what you lose in a high beta stock or a technical stock that should be growing a lot that doesn't. All right. Or if you catch like Shopify, one of the strongest ones out there as far as its returns, you could have 40 terrible picks that do nothing but lose you money. And if you have just one that you allow to grow and you reinvest the profits, that one would outperform 40 bad picks. Okay? So this is not about cherry picking what can work, because you can even be bad at that. And if you use good, simple strategies with consistent execution, you can still be profitable. All right? So finally, like I said, I want to share with you how to never miss an opportunity in Twilio or other high beta growth stocks again, because these signals can happen just about at any time without warning. And some of them work and some of them don't, but we need to be in all of them in order to participate. Now, something I wanted to show you that we didn't get into yet is what it looks like when it's working and what it looks like when it doesn't. All right, so here's an example right at the end here. What it is, you see the buy signal here. There's the indicator right here. I'm kind of in the way, but here's the indicator here. It's crossed above, so it bought the next bar, and it holds all the way up to here, and it takes a ride from 109 to about 185. Massive move. But in order to be in that, guess what you had to do before? I'm going to zoom in so it's very clear. All right, so right here, let me just zoom over just a bit. Hang with me. This is really, really important for your consistency in trading and actually making money out of great ideas. Here's a signal to buy. It closed above, so it bought the next bar, and then you got back out the very next bar. That's irritating, right? And then a little bit later, 11:30, the next day, you get a signal to buy, and then the very next bar you have to get out again. That's irritating. And then you're moving along. Actually, the next bar you get in. So you have two quick losers in a row, then you get in, and that one actually does pretty well. So that was good. You're like, all right, I'm feeling pretty confident now. But then you have to buy again, and you sell and you break even. You buy again and you lose some. It drops, so you're kind of happy you weren't in that. That's nice. And then you buy, and then this is where it gets tough. All right. Then here at 11:30 on the 6th you buy, and the next hour you have to get out for a loss. And then you get in again on the next bar, and you get out again 2 bars later for a loss. And then you get in again, and then you get out 2 bars later for a loss, and then you get in again, and guess what? That's the one that rides to the moon. Okay? This is a very, very difficult thing. That's not even the biggest one. I actually didn't even zoom in. That's just a medium-sized win there. The actual bigger winner came later. But you've got to go through this one and this one to get this one. And then you got to go through this one, this one, this one, this one, this one, this one to get this one. Okay? Most traders struggle heavily to do that. To first of all be around for every one of them, to know that a lot of them aren't going to work, but do it anyways. And then when something is moving, you get these 2 big green bars, and you think, man, if this just turns around and turns into a loss again, I'm just going to have another loss stacked up. It's going to be irritating again. And to let it go. And when this happens, just to let it go. And when this happens, to let it go. When this and this and this and this happens, to let it go, so you can stack up that reward that finally comes. Most traders cannot reliably and consistently do that. But if you want to participate in those very large moves that come later, then you've got to go through those trades. And what many do, and why they make trading so complicated, is they're trying to figure out how to not deal with this and just get this. That's where you get into overfitting, and that's where you have difficulty finding something reliable. All right? So how can you never miss these opportunities? How can you stay consistent and be in them? The question is, do you believe that using good signals on fast-moving assets can make you profitable? If you really believe that's true, then you should be in every one of these trades. And do you believe that following the rules every time is important for getting the results of the strategy? That you can't just cherry pick which trades to take, because if you base your decision on the last 3 trades, then you're going to miss out on the next big one. That really big trade that's followed, that comes after 1 or 2 or 3 losing trades, has no less probability than the first one. The first one could have moved that much, the second one could have, or the third one, but whichever one it is, you don't know. You just can't know, so you have to be consistent every single time. And as I showed you all these other stocks, some of these are going up when others aren't. You don't know that Groupon isn't going to be the winner for the next 10 years, and Apple's going to be the loser. Twilio could be the loser for the next 10 years, and Groupon could resurge out of the ashes and grow to the moon. So, isn't it better to be in multiple of these? Maybe 5, 10, even 30 different stocks? So whichever one is growing, you can compound and get the returns from that? Well, if you followed just 5 strategies on intraday 30 or 60-minute charts, it would take nearly the equivalent of a full-time job to keep up with it. And the question is, can you reliably take every one of these trades on time, at the close of every bar, every time, exactly as planned, without errors or intervention or deviation or second guessing. And I'm guessing like most of the traders, cannot. Essentially, all traders who do this manually are not able to. Me either. I've tried and I can't do it, but there is a solution that allows me to be in these stocks, 30, 40, 50 of them at a time, on a variety of time frames, and participate no matter what. And that's through fully automated trading. And with fully automated trading, you can go from being an inconsistent manual trader to running a fully automated portfolio of high performance trading systems. And you can have strategies like that RSI system running on full autopilot even if you have no prior experience with automation. And you can learn all of that in about 4 weeks if you just commit about an hour to an hour and a half a day to learn it and implement it. And I've done it for dozens of traders just over the last few months, most of who have no prior experience with coding or programming or automation at all. In 4 weeks, they went from manually trading with inconsistent, unreliable results to fully automating their trading. And I like to show you how to do it too. So to get started, I invite you to go watch a video, watch a presentation, learn all about this at learnautomatedtrading.com. And how does it work? You follow the steps in the training. You copy and paste code into your trading platform. You don't have to build things from scratch. You can use what's already been built for you, like this RSI strategy. You select the stocks and ETFs or even futures that you want to trade, and then you turn it on and watch it trade for you. Now that's actually a very important step. All right? I look at automated trading as kind of like having maybe a teenager in the house. Teenagers are somewhat independent. Many of them can go take a car and drive around, and they can go get their own food, and they can do things for themselves. And you don't have, like a baby, you don't have to watch them and do every single thing for them. But as a teenager, you still need to be watched. You still need somebody watching out for you. Just like that with your automated systems, you need to keep an eye on them. You can give them freedom. You can let them do what they do, and you don't have to stare at them all day long and take care of every single little thing. But you do need to know what it's doing just about all the time. Okay? So you do need to watch it, but you don't have to do every single thing for it. Big, big difference. And another question I get is, can I customize a strategy? Yep, I'll teach you how to do that. You can customize a strategy or build totally custom strategies from scratch. So whether you want to come up with totally new ideas or you want to take what's already been built and make it your own, you can do that. And a big, big question, how do I know it's going to keep working? You don't. You don't. But it has worked for me. It has worked for others. And I don't just mean for months. I'm talking about years, that strategies can continue to work when you implement them. And if you're not getting the results you want right now from what you're doing, probably from manual trading, then this may be a better idea for you anyways. And so does it cost money? Well, this video, as you're watching now, does not cost money. The video at learnautomatedtrading.com does not cost money. But there are options for you if you want to do formal training with me that you can do. But for now, just go to learnautomatedtrading.com, get a little further into it, see if this is the right fit for you, and then we can talk about that later. Another question, is this right for you as far as how big is your account? How big does your account have to be? Any size, literally any size. Whether it's $0 and you want to simulate your trading just to get a feeling for how things work, or you want to put just a couple $100s in just to kind of get the feel of the execution and see how things work, or that's all you've got to start with, or thousands or millions or any amount that you want. The strategy you'll use will have to change. If you have less than $25,000, you can't be a pattern day trader. If you have $50 million, you probably can't trade low float stocks and scalp them very well. You would need to use different strategies. But all of it can be fully automated. The strategies I give you can be applied to a variety of assets on a variety of time frames based on your needs. All right, another question I get is, do you offer funding? Yes, we do. We offer proprietary trading for rules-based traders. Okay, so if you use a rules-based system for either stocks or options or futures, we can look at that and get you funding for that. So summary of what we talked about today. Twilio looks like a great stock to add to your trading portfolio. Looks like it can work with a simple strategy. Works with many other strategies, by the way, that I've looked at as well. And we suggest using a simple and effective indicator to avoid getting stuck on the wrong side of the market if it does not keep going up. And fully automated trading can help you be more consistent with Twilio and other stocks. All right. So if you want to keep learning more about using fast-moving stocks with simple strategies and fully automating them, go to learnautomatedtrading.com. I look forward to seeing you over there, and I look forward to any questions you have on that. All right. Thanks for watching this, and I'll see you all next time.